strong mortgage market for investors. Now, I've mentioned this one separately to the deposit levels because the ability for people to get mortgages in the UK is very, very strong. When you're looking at the buy to let model, they're very much stress testing the income from the property, how much cash flow is in it, how much almost margin is in it on a monthly basis. So that gives both resident and non-resident investors an opportunity to get into the market quite easily with affordable interest rates and a wide range of mortgage products available. So that's really, really attractive. Over 2,000 buy-to-let mortgage products are available, and that's a source from Moneyfacts. Keep that in mind. So, yeah, there's a few for you on the advantages side of the UK. So, long-term stable capital appreciation, strong tenant demand, low deposit levels, a mature legal structure, and a wide range of mortgage products. Disadvantages. What are some of the drawbacks of the UK market? So, we've kind of, it's almost going to be the opposite to the advantages. But in this case, if you look at the appreciation rates, it's very much a slow and steady market. So if you're a very risk on investor and you don't mind rolling the dice and getting into markets and coming out and trading property, then the UK market as a slow and steady crawler, so to speak, is might not be the one for you because it's very much 4 or 5% capital appreciation per year is very typical in markets. Probably over the past 12 to 18 months, we've seen a lot of 2-3% rises. Now it's getting up to 4-5%, which is good to see. But nationwide, Building Society quote 3 to 5% annually as being a stable rate across the UK. So, yeah, slower appreciation, increasing regulation. This is almost in every segment of the market. A lot of it caused some people to say the buy-to-let market is dead. It's difficult for property developers with planning. And yeah, it's just regulation is a burden in the UK. There's no two ways about it. And there's a new law coming in or range of regulations called the Renters Reform Bill, which effectively puts a lot of power in the tenant's hands with notice periods, with evictions, with Section 21 removal. And it just creates a bit more of a hesitation and another barrier and another loop for buy-to-let landlords to jump through, which is a bit of a pain. It's not like a huge impact on the market. There was a lot of negative press around it when it first came out. But when you sat down and looked through the regulation, it wasn't perhaps the big sting that a lot of people thought. Nevertheless, the big one for me is just the notice period for tenants when they can leave contracts. Now you're all on, landlords used to buy a property and go find a tenant for 12 months and go, right, I'm locked here for 12 months now, I'm fine. And often they might stay or renew for another 1-2 years. Now the tenants have the ability to leave. I think it's with 1 or 2 months notice. So that certainty and that predictability of having that tenant in place for 12 months is effectively gone. So it does create a bit of more exposure for the landlords in terms of void periods. So keep that in mind. Regulation, it is a bit of a pain, but as long as you research well, you've got a good managing agent in place, then you should be well prepared for that. Tax, obviously, that is a very, very big one. Especially for non-resident investors. A lot of UK investors are kind of used to dealing with tax in the UK because they're paying huge amounts of it from when they start working. So not such a hit. However, what I would mention is stamp duty rises. We've seen that. Corporation tax rises. We've seen that. Income tax hasn't been too much of a change. But so that's for residents. They do understand and have to buy in a company name to mitigate that tax exposure. For non-resident investors, it's a big one because you get the surcharge on the stamp duty land tax now, which in other words means when you're buying a property, you have to pay a lump sum of tax. Used to be a lot lower. Now there's a surcharge for non-resident investors of 3%. So that's quite a hefty amount. Some of these properties, when you're buying in London and you're buying a non-resident investor purchasing a buy-to-let property in London, you're going to be paying tens and tens of thousands of pounds in stamp duty. It's really, really quite significant. And that doesn't include taxes such as inheritance tax, capital gains tax, etc., etc. So just what I would say around that is just make sure you're planning appropriately. You're negotiating the deal. You make your money when you buy the property, not during the ownership is kind of an old school cliche in property. But in other words, make sure you're negotiating if you're buying from a developer effectively. If you're buying on the secondary market or from an end user, make sure you're trying to haggle and get them down as much as possible. Do the appropriate planning with tax. Speak to a qualified accountant. Make sure you're utilizing all the benefits, writing off relevant expenses, tax planning in terms of withdrawing capital at the right time, making sure you're loaning money to the company effectively and withdrawing dividend payments in the right structure. All these little things you've got to plan. There's no room for luck or chance anymore. So get the relevant advice around tax, but that is a big disadvantage of the UK. Short-term let restrictions, and I've written here as well HMO restrictions. So things like Article 4, where you're going into or where you're buying a HMO property, so house of multiple occupancy. In other words, you have 4, 5, 6 people in there, all sharing communal facilities such as kitchens, but they have their own room typically. In some places now, you need to get planning special permission for that in from the local authority, which is called Article 4. It's good if you've already got a HMO because it restricts the further HMOs coming to the marketplace and reduces your competition. But it is a pain if you want to be a HMO investor, or you've got, again, just more regulations, more loopholes to jump through. And short-term let restrictions in the UK, you do need, or in England, you do need approval in the lease to operate a short-term let model. And not all developments have that. So again, it can be good. It does, if you do get that in your lease, it does differentiate your property for when you come to resell it, and can potentially increase the value. But it is more restrictions. So HMO restrictions, short-term let restrictions are things to keep in mind.